Lesson 8, the reversal and the king's crown. Before we get started, I'd like to point out a couple of things. During this lesson, you'll see this sign show up that's up in the top left-hand corner. That means that on that page there's some very important information that you may want to memorize, read, reread, have it become a part of your trading style. It could be a trader's tip. In the bottom center of each one of these slides is the number of the slide. If you look at that same number on your workbook, that is in your workbook. If you get lost along the way, just match up the slide that we're looking at to the number in your workbook and you should be okay. There are 16 lessons on trading the Forex to help you. These lessons focus in on technical analysis. They also can help you in other financial products. Successful traders will do what unsuccessful traders can't and won't do. Think about it. What's the difference between you and a successful trader? Change the word traders to people. Successful people will do what unsuccessful people can't and won't do. I've found in my life that successful people are successful for a reason. Successful traders are successful for a reason. You'll find out that most successful traders have taken the time to educate themselves on how the market works before they get involved. There is a 21-day 3% rule. The human mind forgets 80% of the knowledge it acquires within 3 days. Over the next 18 days, it continues the loss of information until it settles at retaining only 3% of the original acquired information, which means if you don't use it, you lose it. Play this lesson over and over again until you completely understand it, until it becomes a part of you in your trading style. By the end of this lesson, you will understand that the markets can only move up, down, and sideways. You'll learn how to read a trading chart and be introduced to the technical side of dealing with a reversal. Now think how important that is. A lot of people have lost a lot of money in the stock market. They bought a lot of tech stocks. As the markets rally, what goes up must come down. Traders that can identify that reversal end up saving themselves a lot of money. There's a saying, there's no greater fool than an ignorant bull in a bullish market. If a trader does not know how to spot a reversal when they get in the market, all they will be doing eventually is watching that market come straight back down, and if they don't know how to get out, they will watch all their profit taken away from them. By the end of this lesson, you will learn how to identify a reversal and how an uptrend and downtrend crown is formed. You will learn how to find a trading opportunity in just about every reversal. You will learn how to create a trading plan and financially protect yourself in every trade. In order to help you with this lesson, let's review the trading chart and placing orders, which is lesson 1. We look at Japanese candlesticks, which monitor an open, high, low, and close. There are bullish candles and bearish candles. Bullish candles mean the market is rallying. They're usually hollow and white candles. Bearish candles are black. They usually have wicks on each end of the candle, which represent the high or the low of that time period. We are looking at a bid price chart. Most charts out there are bid price charts. They are monitoring the bid price. There is always a bid and an ask. Trading is an auction. Sellers are asking a certain price for their product. Buyers are bidding. The bid price is lower than the ask price. The ask price would look identical to the bid price if we were charting it. It would just be a few pips or points higher. In the currency market, the ask price is anywhere from 3 to 10 pips higher than the bid price. A trader buys on the ask and sells on the bid. This is very important information. Why is it important? If you decide to buy a product, you will be buying on the ask. This is not the ask price. This is the bid price. So if you entered the market at the market and you're buying on the ask and the spread is approximately 5 pips, you would be buying at 107.35. Every buy needs 2 sells, one for profit and one for potential loss. You will sell on the bid, which means all the candle has to do is come up and hit your price, and it should fill your order. Conversely, you sell on the bid. All the market has to do is the candle has to come down and hit your price, and you should somewhat be filled. Conversely, we sell on the bid on entry. If we sell on the bid and we jump in the market to short the market right now, our fill would be 107.30 because we sell on the bid. If we place a protective loss stop order up here and the market starts to rally, think for a second, the ask price is going to hit your stop order before the bid price. This is where a lot of traders run into trouble. The ask price hits their order, the candlesticks never hit their number, and they think they're still in, yet they've been stopped out. Conversely, since we buy on the ask, if they've placed a limit order to get out down here, then what will take place is the bid will go through it first, and many times trader thinks just because the candlestick hit it, their order is filled, when in fact the ask price has to hit their limit. This is a very important trader's tip. Please understand it before you start trading. It will help you avoid a lot of emotional frustration. The types of orders we use are a market order, a limit order, and a stop order. We go into great detail on this in lesson 1. And so if you have any questions about this, feel free to purchase lesson 1 or give us a call and we'll explain to you the difference between a market order, limit order, and a stop order. If this is where the market is, anytime you place an order above the market, that order is called an open order. It is also called an unfilled order. It is also called a working order. If you place an order to buy above the market, that order is called a stop order. If you place an order to sell above the market, that order is called a limit order. Conversely, if you place an order anywhere underneath wherever the market is, down here, when you buy below the market, that's a limit order. When you sell below the market, it's called a stop order. Those are the rules of trading. It's something you have to memorize. Ordering rules: every buy should have 2 sells, one for potential loss. Before you enter the market, please quantify your potential loss. If you cannot afford to trade it, pass on the trade. Also, you should have a projected sell. Let's look at this right here. The market enters into the buy zone, which is lesson 6. If you buy, you should have a protective sell stop and a sell limit up here for profit. Every buy should have 2 sells. Ordering rules: when you're shorting the market, every sell should have 2 buys. A buy for potential loss, which is your stop order, and a buy for profit, which is your limit order. Let's look at this chart. Market enters into the sell zone. It crowns, which is what we're going to be talking about today. And we enter the market. And as we enter the market, we place a protective stop loss order. Every sell needs 2 buys. This would be a buy stop. This is a buy limit for profit. OCO means whenever you enter the market buying or selling, your 2 opposing orders will be attached to the entry order. Whichever the market hits first, if it hits the limit order, it'll cancel the stop order. If it hits the stop order first, it'll cancel the limit order. You literally can enter the market, set it, and forget it. Please remember when you cancel and replace to only cancel and replace to the last low after the market has achieved a new high. If this was where your stop order is and the market is rallying and then it retraces back, let it come back and move in its natural harmonic vibratory fashion of the Fibonacci's, and then when it U-turns and rallies and achieves a new high, while it's achieving a new high, now you can cancel replace to your last low. Let the market retrace back after it forms a high, bounce at its Fibonacci number, rally when it starts to achieve a new high from the last level of resistance. Now you can move your stop order to lock in more profit. Canceling and replacing is not a greedy way to trade. It is a very educated way to lock in profit. If traders in the stock market would have properly canceled and replaced as their tech stocks rallied and went through the roof and split, when the market finally reversed and came back down, they would have been stopped out, locking in profit, and instead of watching all their profits disappear while the market came back down, hoping that it would return, they would have been able to profit from their trade. It works the exact same way, but in an opposite fashion as the market is reacting or dipping. The greatest part about trading currencies is you get to make money as the market goes down, provided you have entered the market short, selling. That is called entering the market as a bear. You have shorted the market. You are hoping for a reaction, a dip. And as the market starts to dip, if you are chasing the market, do not cancel or replace until the market has established a new low. And when it establishes a new low, you can now cancel your stop from the last high to the new last high. Let's just say this is where you enter the market dips and falls, there's where your stop is. It establishes a low, rallies a little bit, U-turns. Now that it has made a new low, taking out the old low, cancel and replace your stop from that high to this high. As the market dips and falls, bounces, U-turns, cancel, replace when it establishes a new low. Lesson 16 goes into detail about canceling and replacing, as well as lesson 3 on equity management. In the market, you get to be a bull. Bulls buy low and sell high. Later, a lot of traders use indicators. We have a great lesson, lesson 3 on trading indicators. Bulls want to buy low and sell high. Buy low, sell high. Their first entry is a buy. Bears, they want to do the opposite. They think the market is going to dip or fall, and you can make money shorting the market as it is falling. You will just reverse your transaction. You will sell first, then buy later. Sell first, buy later. But you will need to sell high and buy low, which is really buying low and selling high. It's the exact opposite of buying first and selling second. You are selling first and buying second. Be that as it may, when you sell high and buy low, you literally bought low and sold high. If you sold something for $107 and bought it for $104, didn't you buy low and sell high? Therefore, you made a profit of roughly $3. If you don't know how to short the market, please give us a call. We will gladly explain it to you. There's also an explanation in the back of your workbook. Technical traders learn to read charts. They read charts like doctors read x-rays. To the trained eye, charts are telling a story. Technical analysis gives traders a high probability of knowing where the market is going. That's what this is all about. This lesson is going to focus in on the reversal. A chart is a chart is a chart. Technical analysis is applicable to all markets and anywhere you can pull up a chart. Once you have been educated on how to read a chart, you will start to control your financial future, and you will no longer be vulnerable to hot tips. You'll no longer be vulnerable to the perhaps advice of a broker who many times doesn't know really what the market is going to do. Reviewing support and resistance, which is lesson 2, will be helpful in this. Remember What a high is, it is 2 candles to the left that are lower and 2 candles to the right that are lower than the wick or candlestick high. We need to know highs and lows in trading, and support and resistance. Not all highs are levels of resistance. Only higher highs that are being created become new levels of resistance from where the market is currently trading. That's lesson 2. Lows have 2 candles to the left and 2 candles to the right that are higher than the center low. Whether it is a wick or a body, this then becomes a low. And once again, not all lows are levels of support. Only lower lows that are being created become new levels of support from where the market is currently trading. Before you trade, find all your levels of resistance and support. Do not underestimate the trading game between the bulls and the bears. The bulls, here's the current market. If bulls grab control of the market, they will start to rally and they will start to achieve new highs. They will what's called take out all these old highs or levels of resistance. If the bears take control, they will take the market down. It will have a reaction and they will start to achieve new lows by taking out these old lows. Knowing where your levels of support and resistance have a lot to do with knowing where to place your stops. Whenever you sell, you place your stop order at the last high. When you buy, you place your stop order at the last low. Let's review trends and trend lines quickly. The market moves in waves. Those waves are called price swings. When the price swing is going up, it starts at a low and stops at a high. You can see this is an up price swing, starts at a low, ends at a high, then retraces. Uptrends are a series of up price swings and extensions, which we go into detail in lesson 7, the price swings and Fibonacci numbers. But when the market is making higher highs and higher lows, it is in an uptrend. Look at this. The market is making higher highs and higher lows. That is then called an uptrend. When you spot an uptrend, you will draw your trend lines across the lows of support. Now there are 3 trend lines that we're going to monitor. See how we drew this trend line across the lows of support? There's 3 trend lines we're constantly monitoring. One is the long-term outer trend line, the outer trend line, and the inner trend line. Please refer to lesson 5, which discusses in detail trends and trend lines and how to draw them. Our objective is this. Whenever we spot a trend line, we are trying to find a convergence. It becomes a location where the market should bounce, and what we want to do is we want to, in an uptrend, buy the trend line bounce, as well as at a Fibonacci number or a convergence of perhaps a morning star, at the end of a beat, perhaps at the end of a Gartley. These are all the different lessons that can teach you how to become a great trader. There are trends inside of trends. Look at this as an uptrend. Trend line breaks, crowns, we're going to discuss that, goes down, trends down, crowns, trend line breaks, and then trends up. Look at how there are trends, uptrend, downtrend, uptrend, inside an overall uptrend. Look at this chart. Uptrend, trend line break, down, trend line break, trends up. Trends inside of trends. Look at how it bounced right here at the trend line. Just from drawing your trend line from the lows of support across, we anticipated this bounce based on drawing our trend line across these lows. When the inner trend line is broken, the market predominantly will move to the outer trend line. That's why there's 3 trend lines we monitor. Look at how the inner trend line broke here, moved to the outer trend line, and bounced. This location becomes a projected area for us to buy and enter the market. Trading is all about understanding price movement against time. The market moves in price movements and in time movements to meet its objectives. As time is used up, the trend line will climb. It'll slowly climb. And the market should retrace at points in time to bounce at that trend line. Look at how it rallied, came down and bounced right along the trend line. So down price swings work the absolute opposite. It starts at a high and stops at a low. See how it started at this high and stopped at this low? That's a downtrend price swing. A downtrend is when the market is making lower lows and lower highs. Look at this chart. Chart is making lower lows and lower highs. The purpose of understanding downtrends and uptrends and lower lows and lower highs is so that when you turn on a chart, you can quickly visually see whether the market is in an uptrend or a downtrend without even drawing a trend line. But when you spot a downtrend, draw your trend lines across the highs of resistance. Look at how we drew our trend lines across the highs of resistance. There are 3 down trend lines that we monitor. One is an inner, second one is an outer, and the third one is a long term. Our objective is the opposite. We want to short the market when the market has retraced back and bounced at a trend line. When you sell, your stop is at the last high. Look at how we've drawn our trend line across these highs. Right here is where the market is. We are anticipating a sell. If the market rallies and hits that trend line, we're going to short the market with a stop order at the last high, should equity management allow us. Now we're getting into the King's Crown. When the market starts to trend, it just doesn't trend forever. Uptrends end when they bend, and that is when prices start to penetrate the trend line and retrace back to levels of support. See how the market was trending up, bouncing off of these trend lines, and then all of a sudden it crowns and bends. When the trend line bends, it ends. That becomes the first step of the reversal. Lesson 6 talks about buy and sell zones. That can become very, very helpful in understanding crowns. Now, spotting the end of a downtrend, as the trend moves down, as it bends and breaks its downtrend line, it is now reversing. When the market breaks the trend line, comes up to your new last level of resistance after it has completed a low. Look at how the market bent the trend line here, came up to the last level of resistance, but when you study price swings, this was nothing more than sideways movement inside the downswing. This became extension right here when the market came down, started here at the high, ended here at the low, retraced back, went sideways, then went to the extension. After it goes to an extension and it bends, rallies up to resistance, then you have the beginning of a crown, which we're going to start to talk about right now in lesson 8, called the reversal, the King's Crown. Now, the best way to understand what you have learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus what you now know. Your perception is your reality. Write down what you see and think you know about the end of a trend, a reversal, or even a King's Crown. Here's chart number 1. It's a Japanese yen 4-hour chart. See if you can spot any crowns, and you probably don't even know what that is. See if you can spot any trend reversals. See if you can draw trend lines, inner, outer. See if you can see trend line breaks. Pause your machine as you do this. Here is the Dow. Crowns, trend line breaks, reversals, work on all products. Here's the Dow. See if you can spot a crown. Pause your machine. Here's the British pound. It's a 1-hour chart. Crowns appear, trend line breaks appear, reversals appear on all time frames. See if you can find any crowns. See if you can find any trendline breaks. See if you can find any reversals. Pause your machine. Here's the Euro 4-hour. See if you can spot any crowns. See if you can spot any trendline breaks, any reversals. Pause your machine. Here's the Swiss 2-hour. See if you can spot any crowns. See if you can spot any reversals, any trendline breaks. Pause your machine as you go through this exercise. Educating yourself on reversals can help you manage your personal financial portfolio and save you from all kinds of financial losses as well as from all kinds of emotional grief. Successful traders are successful for a reason. You notice how, as the stock market reversed and came down, a large majority of the small investor got hurt, and the large investor seemed to make a lot of money or was even out of the market. Educated traders will do what uneducated traders can't do. Let's look at the Dow. Let's look at how the Dow was going down. It then crowned. You see this little formation here? It looks like an upside down crown. If you wanted to trade the Dow, why would you trade it as it was falling down? I'm going to teach you how to trade the Dow after it crowns and how to get in at literally the first wave of the new uptrend. Now, if you were trading the Dow and you bought down here, now it's time to sell after the Dow starts to break trend lines. Let's just say this was a tech stock. Let's just say this is a currency. Let's just say this is a commodity. You're trading soybeans, whatever the product might be. Technical analysis is applicable to all markets. See this crown up here? Look at this crown up here. Looks like a king's crown. Left tip, center tip, right tip. Look at how if you bought here and sold here, look at how you took a huge slice out of this entire move. And look at how it reversed on you. Now the market is constantly moving, breaking trend lines and creating crowns as it changes directions. It was rallying, crowned, reversed, came down, crowned, and now it's rallying again. What goes up must come down, and in the market, what usually goes down predominantly comes back up. So at the end of a downturn is when we want to get in. Look at this king's crown. It looks just like a king's crown. A left tip, a center tip, a right tip, and a fall. Look at how in the trading arena, how the market broke a trend line, market enters into the sell zone and falls, but then as it comes down, it breaks another trend line. This is the downtrend line. Market enters into the buy zone, crowns again. Look at this upside down crown, and then rallies again. If you have difficulties seeing upside down crowns, print your chart out. Then turn the chart upside down. You'll see the crown. This upside down crown will look just like this. These are what are called uptrend crowns. An uptrend crown is a crown that looks like a king's crown that is sitting on a table upright. Look at how the market rallied, making higher highs and higher lows. Then the trend bent, and as it bent, the market came down to the last level of support, rallied one last time, and then fell again. Look at how it rallied again here, making higher highs and higher lows. Trend line bends, comes down to the last level of support, rallies one last time, and then falls. What usually goes down in the market comes back up to a degree. Look at how it starts to rally again, making higher highs and higher lows, bends, and then the market turns around and comes back down. I'm going to teach you all about this. Now look at what's called downtrend crowns. This is where after it went up, it came back down, broke a trend line, then went back up, forming a left tip, center tip, and right tip. Look at how as it fell, it made lower lows and lower highs until it bent. When it bent, it came back up to the last level of resistance, fell one last time, and then rallied again. Now, how an uptrend crown will form, I'm going to walk you through this step by step. This is step number 1. The uptrend ends when it bends. Prices first penetrate the trend line. This does not signify an end of a trend, just the first step. Now, you must understand lesson 5, which is how to properly draw your trend lines. But in drawing your trend lines in an uptrend across the lows of support, look at how the market is bending here. See how it's bending? Now the candle has come through and closed on the south side of the trend line. That is step number 1. The trend line is started to become broken. Now you must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking a trend line. It could be a false spike. Uptrend crown formation number 2. Once it breaks the trend line, the market must return to the last level of support, or at least 92% of the last upswing. If this is 0 and that's 100, it must come down to at least 92%, if not 100%, of this last upswing, meaning it'll return all the way back down to support. When it comes down all the way to support, then the first 2 tips of the crown have been formed. This then becomes the left tip. This then becomes the center tip. What then should happen is a right tip will form. This center tip will then become the beginning of the new downtrend. Now let's look at this. Here then becomes the right tip. Market came up. It came all the way back down to support. See how it came down to support? Now the uptrend crown formation, step number 3. When the market comes down to support, it must establish a low after it's broken the trend line. Just because it came down does not mean that it has formed a low. We must be patient and wait until a low forms, which is 2 candles to the left and 2 candles to the right. Look at this low. Market came down, bent, broke the trend line, came down to support, and now we sit and we wait, and the market has formed 2 candles to the left, which are higher, and 2 candles to the right, which are higher. That then becomes the low. It is at this point, step number 3, that we are going to start anticipating trading a crown. Now, step number 4 is optional. A lot of traders use indicators to trade. What we have on here is a moving average. You can learn a lot about trading indicators in lesson 4. Indicators can help a trader visually see when lines start to cross that the market is reversing. In this step number 4, what we would want is we have 2 moving averages, a fast and a slow. You would want your candles to hit the slow moving average. Let's look at it now with an indicator on it. See how all of a sudden the indicator has come together, but the candles have hit the slow moving average. This is giving off a sell signal right now, indicator wise. But we have steps number 1, 2, 3, and 4. Now, with the completion of steps 1 through 4, you will now start to set up your trade and trade a reversal. The center tip of the crown should be the high of the new downtrend, and you will learn how to get in on wave 1 of the new downtrend. Now, uptrend crown formation, step number 5, is The market will rally one last time and form the right tip of the crown before it falls. And we are going to teach you how to get in on wave number 1. Look at now what took place. Market formed a left tip, bounced at a trend line, formed a center tip, broke the trend line, came down to support, rallied, formed a right tip, and fell. See how the center tip became the highest high of the new downtrend, and how we're getting in on roughly the first wave of this new downtrend? Can you now see the crown? Can you now see how these crowns formed step by step? Pause your machine and mentally walk through steps 1 through 5 on all these crowns. Now, I'm a fanatic for natural formations and for Fibonacci numbers in our lives and in nature, but look at how even mountains, as they grow and they peak, they crown. See the crown in this mountain formation? Look at the crown in this mountain formation. Look at the crown in these mountains. As you travel throughout the world and you look at the skylines of mountains, take the time to see if you can spot a crown. What goes up must come down. As people climb mountains, they have to come back down as a rule. Now, there are inner and outer trend lines, and because they're inner and outer trend lines, when the market breaks an inner trend line, it will usually crown and work its way out to the outer trend line. You will usually see a small crown when the inner trend line is broken. Look at how we have an overall outer trend line formed, but yet the market created a small crown as it worked its way to the outer trend line. If you look very closely, you'll see a small crown in here. Left tip, center tip. See how it came back down to support? Right tip and fall. There became a trading opportunity right within this crown, because there's little crowns inside of big crowns. Now there are 5 different uptrend and downtrend crowns in this lesson. This lesson is filled with a lot of charts. Your success at trading a crown reversal will be solely dependent on how much you study and practice trading these 5 crowns. Now let's look at uptrend crown number 1. If you look closely, we have a trend line break. This then is the left tip, this is the center tip, and this is the right tip. I think you can see the crown. Look how the left tip is high compared to the center tip, and the right tip is high compared to the center tip. Let's look at it on a chart. Look at how we were making higher highs and higher lows. Left tip is high in comparison to the center tip. Right tip is high in comparison to the center tip. Look at how the left tip and the right tip are equal. But look at how when it crowned or met the criteria of the 1, 2, 3, 4, 5, it came down, rallied one last time, and fell. We're going to teach you how to get in right at this entry of the right tip. If you got in with the right tip, shorting the market with a stop order at the last high, look at the payoff. Huge payoff. Look at this crown. Market is making higher highs and higher lows. It finally breaks a trend line. Left tip, center tip, right tip, fall. This is called uptrend crown number 1. Look at this uptrend crown. It has a high left tip. Market comes back down. Center tip comes down to support, breaks the trend line. High right tip, right and left tip are equal, and fall. Look at how the right tip is roughly the first wave of the new downtrend, but the center tip is the highest high in the new downtrend. Here, I don't know if you can spot it yet, there is a downtrend crown. Now, uptrend crown number 2. That is where the left tip is lower than the right tip. Left tip, center tip, right tip. Let's look at this chart. See the crown? We were in an uptrend. We have a left tip, center tip. Market breaks the trend line, rallies one last time, creates a high right tip, and then falls. Crown number 2. Low left tip, trend line break, high right tip, fall. Nice fall on this. A lot of profit there. Look at this trend line. Market rallies, has a low left tip, high center tip, high right tip, and then breaks the trend line here, rallies, and then falls. This is uptrend crown number 3. Now uptrend crown number, that was crown number 2. Uptrend crown number 3 is where the right tip is lower. Now look at how we have a high left tip and a low right tip. Left tip, center tip, low right tip, and then the fall. Look at this one. Market's in an uptrend, making higher highs, higher lows until it breaks the trend line, hits the right tip, and falls. Study these charts. Here's another one. High left tip, we're making higher highs, higher lows until we penetrate the trend line, come down to support. We rally back, hit the opposite side of the trend line, and then fall. Many times the market, as it breaks the trend line, it'll rally back up and hit the opposite side of the trend line before it falls. This is crown number 3. Crown number 4, that is where the left tip and the right tip are usually low tips against a high center tip, and they're usually equal. Let's look at this one. See how the left tip is low, right tip is low, and the center tip is high? See how the center tip is the highest high of the new downtrend? It's crown number 4. Crown number 4 once again. Low left tip, low right tip, high center tip. Center tip is the highest high of the new downtrend. Look at this crown. Very visible, very easy to see. Study these crowns. There's a lot of money to be made in the king's crowns. Low left tip, low right tip, high center tip, and then the fall. Now crown number 5 is where you can have either a low left tip or a high left tip with either a high or low center tip. Either way, a right tip doesn't form, the market just falls. Look at this. High left tip, we're making higher highs and higher lows until it breaks the trend line, comes down to support, and keeps going. No right tip formed on this one. Look at this one. Higher highs and higher lows, it breaks the trend line and just falls. Usually when it just falls like that, there is a fundamental announcement that has taken place. We talk a lot about fundamental announcements in Lesson 10, Trading Days and Trending Days, as well as Lesson 9, Consolidation and Fundamental Announcements. There's a lot of money to be made on trending days. Now, let's review price swings and extensions because they play a big part with the Fibonacci numbers, which is Lesson 7, in understanding how to trade the King's Crown. Now, remember we discussed about the entire upswing and its extension. The market rallies and then it retraces or reacts. It'll bounce at one of the Fibonacci numbers. It may move sideways, but when it takes out the old high or level of resistance, it now works its way to an extension. See how this is an upswing. It retraces, it bounces at a Fibonacci number and goes up to an extension. When it achieves the new high, that then becomes extension. Now, we also discussed that, believe it or not, the market is governed by natural laws and the world is governed by natural laws, and that Leonardo Fibonacci back in the year 900 AD discovered a numerical sequence, which is the sum of the previous two will equal the sum of the next. 2 plus 3 equal 5, 3 plus 5 equal 8, 5 plus 8 equal 13, 8 plus 13 equal 21. all the way to infinity. And then as we grab some numbers, 89 plus 144 equals 233. Look at where they came from. 89 plus 144 equals 233. When we started to grab our calculator and we started to do our division, we came up with a whole group of ratio numbers, 618 and 786s and 382s and 50s. And we found out that these ratio numbers, 382s, 50s, 618, 786s, equated to percentage movements in the market, and we attached them to what's called an extension, a 1.618 extension and a 1.27 extension. And these Fibonacci numbers became hidden areas where the market should bounce as it retraced. So in an upswing, the 382, 50, 618, 786 becomes a hidden level where the market's going to bounce. And we learned that if the market bounces at a 382, 50, 618, U-turns, takes out the old high of the swing, it should go to the 1.618 or 162%. See how the market came up, bounced at the 382, U-turned, rallied, went to the high, to the 1.27 extension, 1.618 extension. These three are attached to the 1.618 extension. And that if the market retraces all the way back to the 786, bounces and U-turns, as it takes out the old high, it goes to the 1.27 extension. We discuss in detail in lesson 7 why this takes place. Price swings move at different speeds. The 382 bounce is the fastest, with the 786 being the slowest. Down swings work exactly the same and in the same numerical sequence, but just in the opposite direction. You see a downswing. Here's a retracement. It can move sideways. When it takes out the low, it is now extension. Look at how we have a downswing. It retraced back, it bounced, it then took out the previous low, then becomes extension. We have the Fibonacci's in reverse, which is as it starts at this high and forms a downswing, it retraces. As traders, we never know where it's going to bounce, if it's going to bounce at a 382, 50, 618, or 786. We don't know that. All we know is that if it does bounce here and if it does take out this low, then it will go to an extension based on where it bounced. Now, if it bounces at the 382, 50, 618, it should go to a 1.618. Look at this. The market has created a downswing. This one bounced at the 382. And when it bounces at the 382, it should go to a 1.618 extension. That's exactly where it went, and look at how it's starting to rally back. Conversely, if it goes all the way to the 786 and bounces, then it does not have the energy to go to the 1.618. If it bounces at the 786, U-turns, takes out the previous low, it'll only go to the 1.27. Look at this downward price swing, goes all the way up to the 786, bounces, and only goes to a 1.27. That's where it stopped. This is sideways movement inside the original swing. It is well worth your time and investment to go back and study in detail lesson 7. Downswings move at different speeds, with the 382 bounce being the most aggressive to the 786 bounce being the slowest. Now, the reason you want to trade a 618 or 786 Fibonacci bounce in the direction of a trend is if the trade doesn't work out and it starts to reverse, your losses will be small. If you listen to where the market has been with your eyes, it will tell you where it's going to go. Look at this rally here. This is an upswing. If we were to have bought the 618 bounce, which it did, it came right here, bounced, but as it bounced and aggressively started to rally, It did not take out the high. Instead, it U-turned, came back to the 786. Now, if we bought the 618, our anticipated exit would be the 1.618. But the fact that it came back to the 786, we will now not exit at the 1.618. We'll get out at the 1.27 extension. Furthermore, don't cancel and replace your stops until it has either A, started to achieve a new high from the previous high, or B, bounced off the 786. If you entered the 618 and the market started to rally, which it did here, and you cancel and replace your stop from the last low, which would have been here, to your 618 new low, then when it U-turned and formed, this formation is called a Gartley. That Gartley is less than 13. If it forms a Gartley, all it's going to do is stop you out before it rallies up and makes a new high. You will not be able to participate in this profit. So it's well worth your time to educate yourself on how the market works. Now let's trade an uptrend crown. Turn on your trading software from your broker. We have participated in creating some software that allows our traders to practice trade literally before they get involved with their own money. Now here's the rules to trading with a crown. Find and draw all your trend lines, the inner, outer, and long-term trend line. This will help you determine if you are in an uptrend, downtrend, or if the trend line has been broken, signifying the potential end of a trend. Find the trend line break. Remember, if an inner trend line is broken, it may only go to the outer and only create a small move. Find the last levels of support or resistance the market is going after. Do not underestimate the game which you learn in lesson 2 between the bulls and the bears. Find all your levels of support and resistance so you know where to place your stops as well. Follow the potential crown movement steps 1 through 5. If the steps achieve 1 through 3, start setting up your trade. Read and understand all 5 crowns. It will be either crown 1 through 5, and it will start to form. Pull out your trader's checklist and create a trading plan and trade that plan. If you quantify your potential loss and it is too great, if you can't afford to lose, then don't trade. Now let's face the facts. Every trader wants the market to move in their direction from entry. Education on how the market works will greatly improve those percentages. Let's look at what education will do. Now, this is how you trade the crown. Step 1, the uptrend ends when it bends. Prices first penetrate the trend line. This does not signify the end of a trend, just the first step. Now you must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking a trend line. It could be a false spike. Here we have step 1. See how the market has broken the trend line and you have a close below the trend line. The market is now entering into the sell zone. Step 2. The market or prices must return to the last level of support, or at least 92% or more of the uptrend price swing. Now the left tip of the crown will now start to be visible and established if the market retraces all the way back down to your last level of support. Let's look at it. Here we are. We have now hit the last level of support. The left tip has been created. The center tip's been created. Now we need to start to anticipate a right tip. And in anticipation of that right tip, we must wait until the market has formed a low. Find the left tip of the crown. That will give you an idea where the right tip is going to go, because many times the right tip equals the left tip. It will also participate in helping you decide whether it's crown number 1 or crown number 5. Now let's look at this one. The market's come back down to support. It has a low left tip. This is what a high left tip would be. Because this is a left tip that is low, this is crown number 3 or 4. So pull out the rules to crown number 3 or 4. Now at this point in time we have to wait till a low forms. We don't know whether the right tip's going to be high or low, but can you start to envision right now a right tip and then see a full crown? Now the market must establish a low. It is also in the sell zone. Let's see, we've waited now. The market came down to support. It has now formed a low. Now here's where we have to wait until a confirmed low is formed, because if we don't wait till a confirmed low is formed, this could end up being trade number 5. If you are trading the rules of a crown, do not enter buying at this point in time in anticipation of the formation of the right tip. If you were to buy right now, this market could U-turn immediately. If you're trading with an indicator, make sure the market has hit the slow moving average and try to look for a crossover of the moving averages. If you're trading with them, look at how we have the left tip here, the center tip, and look at how it is crossing over, giving a sell signal. So it looks as though the market's reversing right here. With the completion of steps 1 through 4, you will now start to set up your trade and trade a reversal. The center tip of the crown should be the high of the new downtrend, and you will learn how to get in on wave 1 of the new downtrend. With the completion of steps 1 through 4, as the right tip forms, you don't know whether it will be a high right tip or a low right tip. The reason you always find the height of the left tip is because the right tip usually equals the height of the left tip. You really don't know whether the right tip will be high or low, or even if it will form. All you know is the market is potentially reversing and a trading opportunity is forming, and you want to trade the reversal with the best fill. That is why there are rules for all 5 crowns. Follow the rules. Now spread your Fibonacci's, which will then give you your retracement values. See how I've spread my Fibonacci's from the swing high to the swing low? Okay, I've spread my Fibonacci's. This is the 382, 50, 618, 786. Look at how if it bounces at the 382, the left tip is low, the right tip may be low. Can you start to see the crown? Now, since this looks like it is crown number 3 or 4, place an order to sell at the 618 with a protective stop loss order at the last high. Now the market should bounce at one of these 3. And if it bounces at one of these 3, it should U-turn, take out this low, and go to a 1.618 extension. If it bounces at a 786, it will only go to a 1.27 extension. Now you're going to place 2 orders here. One is if the market will bounce at the 382, you have placed an order to sell the 618. But if it bounces at the 382, you are going to sell this low. And you learned how to sell a very aggressive 382 bounce low in lesson 7 under price swings and Fibonacci numbers. That means that if the market bounces at this 382, you will sell this low, which is the low of the downswing, and as the market takes you in here, you will place your protective stop loss order at the last high. Walk this through in your head mentally. Practice it. So right now that the market has established left tip, center tip and going to form right tip, we have placed an order to sell this 618 or to sell this low. We don't know where the market's going to go. All we have done is anticipated a reversal based on the market meeting our criteria of breaking the trend line, hitting the 1, 2, 3, 4, as well as this indicator telling us it is reversing. Now, we must wait until price movement and time match our objective. This is where the trader's mantra comes in. And the trader's mantra goes like this: I will educate myself on how the market works. I will learn how to find and place a trade. I will trade with equity management. If I can't afford to lose the potential loss, I will not trade. I will never trade without a protective stop loss. I will not think that I know everything about this market and I don't need to stop. That's when you're going to get liquidated. I will not chase this market. I will be patient. I will wait until the market meets my criteria, or I will not trade. Now that's a mantra you have to buy into. And before you trade, you need to decide whether you're going to just go for a quick profit as a day trader or you want to go as a position trader, perhaps 2 or 3 days. You may want to cancel and replace this. Either way, decide that. Pull out your trading form, fill out your trading form, find out all your levels of support and resistance, write your dates, the currencies, circle the crown that you're trading, fill out all your paperwork just in case your computer crashes. Now we're into step 5. The market should rally one last time to form the right tip of the crown and then fall. The market's going to take you in at either one of your open orders, which means the market will take us in at this low or at this 618. And now that time has been eaten up, the market has now taken us in at the low. Now that the market took us in at this low, we will cancel our 618 order, and we will place our protective stop loss order at the last high, which is this 382 bounce high, and we will set up our limit for profit down here at the 1.618, because that is how the price swing works. Market came down, it is now reversing. If you really look at it, we are in an overall downtrend. See how from that high to this low, looks like the market came back about to the 80%, 79%, bounced, and we're now reversing. So we're now working on an extension, which is going to be the 1.618 extension. If we go down to the 1.618 extension, we're back into the game of the bulls and the bears. We will take out these old levels of support and achieve a new low. Let's watch what happens. Look at how the market crowned. We got in by selling this low. The market took off, took out all these previous lows, which is lesson 2, support and resistance, and see how the center tip of the crown became the new high of the new downtrend, and see how we got in on wave number 1 approximately. Now your charting software will monitor your P&L, but please fill out your profit and loss statement on your trading form. Print out at the top of the page, print out the chart, and keep a record of what you did so that you can go back and see what you've done. Now, can you see step by step how these crowns were formed and how you would have traded them? Pause your machine and digest this. Get it clear in your head. And once again, here's important information. The reason you sell a 618 with a stop at the last high, or you sell a low with a stop at the 382 bounce high, is because they offer small potential losses with good equity management. In fact, not all crowns work out. Look at this one. I saw a trend line break. The market bounced, came down to support. Here was my anticipated sell. I entered the market at a 618. The market came up, took me in, but then it kept on going. See how my loss was small? If I would have shorted it here in anticipation of a 382 bounce and I just got in here, look at the risk here. Sell those 786s or 618s. Trade those 786s or 618s. Look at this one. I was in an uptrend. Market created a low left tip, a high center tip, and a low right tip. I shorted the low. Look at how the market took me in. But as it rallied, it took me right back out. My loss was small. I did not have to agonize over all this loss. 382 bounce entries at those lows or a 618, 786 entry offer great equity management trades. Look at this one. I had a low left tip and a high left tip. Market rallied up, hit the high right tip. I entered at the 618, bounced. The market should have bounced and come down. I had my stop at the last high. The market rallied, took me out, and my losses were small. Keep your protective stop loss orders tight. If you can't afford to trade, then don't trade. Look at how I anticipated a high right tip. The market came up. Obviously a fundamental announcement right here. This was consolidation. You'll learn a lot about consolidation in lesson 9. We might have straddled the market in this consolidation and not even traded the right tip of the crown. But be that as it may, the market stayed in an overall uptrend. It did break the inner trend line, but stayed in an overall uptrend. There are uptrend crowns inside of crowns. Look at this overall huge uptrend crown. Trend line was broken. Right in here is a small little crown inside this big crown. Look at how you have a little crown inside a big crown. Pause your machine and really look these crowns over. Not all crowns are geometric. I know we want to be able to turn on our machine and have a perfect little crown formed there, but look at how different this crown looks in size. This is still a crown. Market's in an uptrend, making higher highs and higher lows. It breaks a trend line, rallies and bounces off the opposite side of the trend line. Look at it. Look at this crown. Left tip, center tip, comes all the way down, breaks the trend line right here. See the connecting of the two trend lines, breaks the trend line, comes down to support right there. Low left tip with a high right tip, rallies, smacks the opposite side of the trend line and falls. We would have shorted this low right here. That would have been our entry with a stop at this last high. Now the market is constantly moving, breaking trend lines and creating crowns as it changes directions. See how it rallied, created an uptrend crown, and then it reacted for a period of time, and now it created a downtrend crown. What goes up must come down. Now this is how a downtrend crown will form. In a downtrend, as we draw our trend lines across the high, the market will break the trend line. Look at how the market started to break the trend line, and you now have closed candles on the north side of the trend line. You must wait until you have a completely closed candle. Do not enter the market just because a candle is breaking a trend line. It could be a false spike. Now, after the downtrend line has been broken, the market must rally up to the last high or level of resistance. It must at least come to 92% more or more of the retracement of the last downswing. Now see how we broke the trend line? But as we broke it, we now penetrated the trend line. We now have closed candles on the north side. We are in the buy zone, which is lesson 6, and we have come up to resistance, the last level of resistance. That's step 2. Now step 3 is when the market establishes a high, which is 2 candles to the left and 2 candles to the right. Look at how the market rallies and forms a high. 2 candles to the left, 2 candles to the right. This is now when we start to set up our trade. If you cannot see the uptrend crown, the downtrend crown forming, you may want to print it out. Now, here once again, using indicators, the candles must hit the slow moving average as well as potentially give you a buy. Let's see what it does here. Look at how the fast moving average is slowly coming up to the slow moving average and getting ready to give you a buy signal. Now with the completion of steps 1 through 4, you will now start to set up your trade and a trade reversal. The center tip of the crown should be the low of the new uptrend, and you will learn how to get in on wave 1 of the new uptrend. Now this is what we're going to do. This is what the market should do. It will dip one last time to form the right tip of the crown and then rally. Look at what it did here. It finally topped out, fell, formed a very deep right tip, and then rallied. Do you now see the upside down crown? If not, take your book and turn it upside down and see if you see the crown. See how the center tip is the lowest low and the beginning of the new uptrend? See how the right tip is swing number 2 of the new uptrend? Do you see this? One other thing I'd like to point out is, do you notice how the market came down and bounced on the opposite side of the trend line? Now we can move on to slide number 195. When the inner trend line is broken, the market predominantly moves to the outer trend line, but it still forms little crowns. Let's look at this. See how the inner trend line was broken? See how the market's slowly moving to the outer trend line? Look at this crown. If we're trading the rules, we are already in and working our way to the outer trend line. Now, there were 5 different uptrend crowns. Well, there are 5 different downtrend crowns. They look identical, just opposite. Turn your papers upside down. Turn your workbook upside down. See if you can see the crown. Crown number 1 has 2 low left tips. Look at the center tip. This is like if you took the king's crown off his head and you put it on his table upside down with the center tip touching the table. See, here's the center tip of the crown. This is the left tip. This is the right tip. It's upside down. Turn your book upside down if you can't see it. But look at how the market came up to the last level of support, hit it, retraced back down, bounced on the opposite side of the trend line, and took off. Look at this. We were in a downtrend. Deep left tip, market penetrates the trend line, comes up to the last level of resistance after it achieves a new low, comes all the way back down, forms a very deep left tip, almost achieves and maintains a new low and a new downtrend, but instead tweezer bottoms and starts to rally. Downtrend, crown number 1, 2 low left tips. Look at how we were in a downtrend. Market penetrated the trend line, came up to resistance, retraced back down, forms another deep left tip, forms a morning star, and then takes off and rallies. Nice, beautiful rally here. A lot of money here, everybody. Downtrend crown number 2. That is where it has a high left tip and a very deep right tip or low right tip. Look at this. Market's in a downtrend, high left tip, deep right tip or low right tip. Crown number 2. High left tip, deep right tip. See how it broke the trend line? Look at how it virtually came and bounced on the opposite side of the trend line, formed a nice morning star, and rallied. Look at this. Market breaks the trend line, forms a left tip, a right tip, and rallies. Can you see a downward trend line right here? Can you see a crown forming right here? See if you can draw it out. Pause your machine and draw it out. Now, crown number 3. It has a deep left tip with a high right tip. Look at this one. Deep left tip against a shallow right tip. Market rallies. Look at this one. Deep left tip. Market breaks the trend line, forms a shallow right tip, and then rallies. Pause your machine and study these if you can't see it. Look at this. Market's in a downtrend. As soon as it breaks the trend line, see, we draw the trend line. We have to wait till it stops, forms a right tip, and then rallies. Crown number 4. They have 2 high right tips. I put a lot of charts in this because I want you to understand how a crown forms. Look at these. Market breaks the trend line. The left tip of the crown should somewhat give you an idea of where the right tip's going to go. Be that as it may, the market moves and swings, and it's going to wave within a numerical Fibonacci harmonic vibratory fashion. Look at how the market penetrated the trend line, rallied, finally stopped, came all the way back down, bounced on the opposite side of the downward trend line, and then took off. It's amazing how this works, isn't it? Look at how the market penetrated the trend line. Look at how unsymmetrical this crown is. If you really look at this crown, it has a left tip here. It has a very wide center tip, but look at how it created a clear line of support, almost a triple bottom on a support level where the market came down, finally comes up, hits the last level of resistance, falls, forms a right tip, then rallies. Crown number 5 is the opposite. It doesn't give you an opportunity to get in. It breaks the trend line and just keeps on going. This is usually because of a fundamental announcement. Look at this one. No right tip forms. This is crown number 5. Rallies and keeps on going. Look at this one. This is obviously a fundamental announcement. Market penetrates the trend line. That's why if you were selling this trend line and your stop was at the last high, your losses would be small. Only sell and buy 786s and 618s with stops at the last high if equity management allows. Now, if you have trouble seeing the downtrend crown, print out the chart on your computer and then turn the paper upside down and you should be able to see the crown. Now let's do a trading exercise. Let's trade the downtrend. Every time you practice trade, boot up your software. Rules to trading the downtrend are identical to trading the uptrend, just in the opposite direction. Find and draw your trend lines, inner, outer, and long term. This will help you determine if you are in an uptrend or a downtrend, or if a trend line has been broken, signifying the potential end of a trend. Find the trend line break. Remember, if an inner trend line is broken, then go find the outer trend line, because if it's a small move, you may want to pass. Make sure there's ample room between your inner and outer trend line. Find all your levels of support and resistance so you know where to place your stops, and so you know where to also place your limits to get in and get out for profit taking. Follow the potential crown movements of steps 1 through 5. If the steps achieve 1 through 3, then start setting up your trade. Pull out your trader's checklist and create a trading plan, and then trade that plan. If you can't afford the potential loss, should the trade not work, then stay out and do not trade. Remember, if the chart does not make sense, when in doubt, stay out. Let's face the facts. From the time of entry, don't we want the market to move our way? Educating yourself about reversals will improve your percentages of the market moving in your direction. Step number 1, market must break the trend line and enter into the buy zone. We turn on our computer and this is what we see. Market is breaking the trend line. We are now starting to prepare for a trend line break. You must wait until you have a completely closed candle. Do not enter the market just because the candle is breaking a trend line. It could be a false spike. Downtrend crown formations. Now, the market or prices should return to the last level of resistance. See how we broke the trend line? We must come up to the last level of resistance, or at least 92% or more of the retracement value of the last down swing. The left tip and center tip of the crown have now been established once the market has hit the last level of resistance. Let's look at it. Left tip, center tip. There we are. Now let's look at it. Did the market come up to the last level of resistance after it made a new low? Yes, it did. Has it broken a trend line? Yes, it has. We now need to start thinking of trading a crown. It is at this point you start to anticipate and prepare for a crown trade. Find the left tip. That will give you an idea where the right tip is going to go. It will also help you decide whether you'll be trading crown number 1 through 5. Now, this is a shallow left tip. So this will then be crown number 3 or 4. A deep left tip would look somewhat with having the chart or the candlesticks come all the way down to here. Step number 3, the market must establish a high. So we got to be patient. We have to wait till it establishes a high, which is 2 candles to the left, 2 candles to the right. Please be patient. You must wait until you have a confirmed high. If you are trading the rules of the crown, do not enter selling right now in anticipation of a formation of the right tip. I've seen a lot of people be liquidated at this point in time. They figure, I'm going to jump in now, I'll grab a few pips, and just as soon as they jump in, the market rallies. Wait till it forms. If you're using indicators, make sure that your candles hit the slow moving average and also look for a potential crossover. The market looks like it's getting ready to cross over. Either way, the candles have hit the slow moving average. With the completions of step 1 through 4, you will now start to set up your trade and trade a reversal. The center tip of this crown should be the low of the new uptrend, and you will learn how to get in on wave 1 of the new uptrend. With the completions of step 1 through 4, as the right tip forms, you don't know whether it will be a high right tip or a low right tip. The reason you always find the height or the depth of that left tip is so that it will help you find out whether and anticipate whether the right tip will be low or high. You really don't know whether the right tip will be high or low, or even if it will form. All you know is the market is potentially reversing and a trading opportunity is forming, and you want to trade the reversal with the best fill. This is why there are rules for all 5 crowns. Follow the rules. Spread your Fibonacci ratios in anticipation of a bounce. That's what we're going to do. We spread our Fibonacci's. Here are then the extensions. This then becomes the 382, 50, 618, 786. Here's the left tip of the crown, center tip. There's the swing. Now, can you start to see the crown? If it does form, it would then bounce on the opposite side of the trend line. If it did come down and bounce at the opposite side of the trend line, we would buy a 618. But if it falls here and bounces at the 382, we're going to buy this high. Now, place 2 orders to buy. Order number 1, buy a 618. The market should bounce at one of these 4 levels, a 382, 50, 618, or 786. If it bounces at a 618, If it bounces at a 38250-618, it should go to the 1.618. If it bounces at the 786, it should go to the 1.27. Now place your second order. Your second order will be that if it bounces at the 382, the market is turning aggressive and we are going to buy this high. If we buy this high, our stop will be at the U-turn or bounce low. If we buy a 618, our stop will be down here at the center tip of the crown. Now we wait, we place an order here at this high, and we place an order at the 618, and we wait. We wait until price, movement, and time match our objective, and we follow our mantra, and we wait until the market meets our criteria. Before you enter the market, you need to decide whether you're going to be a day trader or overnight trader. Either way, pull out your trading form, fill out all your levels of resistance and support, fill in your entry prices, the date you're trading, the time you're trading down here, the currency you're trading, what is it you're trading a crown. Choose to decide whether you're going to just go for some quick profit or whether you want to cancel and replace. You may want to really focus in on lesson 16, which gives you trading strategies and their justification. Either way, create a trading plan, then trade that plan. Now, the downtrend crown formation, step number 5, is where the market will dip one last time to form the right tip of the crown and then rally. Because we have 2 working orders out there, the market is going to take us in at one of these orders. Now look at how the market started to fall, and because it started to fall and did not bounce at the 382, we're going to cancel buying this high because we have now been filled at the 618. See how it came down and it filled us at the 618? We now need to cancel that order, and we now need to put in a stop, which is at this last low. Now the market comes all the way down, bounces on the opposite side of the trend line, and rallies. It has now gone to the 1.618 extension. See how the center tip of the crown became the lowest low of the new uptrend? See how the right tip hit the opposite side of the trend line? Can you now see the crown? This is called a downtrend crown. If you can't see it, turn your book upside down. When you are paper trading or trading for real, you have your P&L statement, which is at the bottom of your trading software. Be that as it may, please fill out your paper trading form, keep a record of your P&Ls that you're making, print out the chart at the top so you keep a record. The reason, once again, you buy, this is important information, at a 618 with a stop at the last low, or buy a high with a stop at the 382 bounce low, is because they offer small potential losses and good equity management. In fact, not all crowns work out. Let's look at this. Market breaks the trend line. Market came down, bounced, took us in. If we were day trading for just some small profit, we did make a little bit of profit right here. But if we were staying in to cancel, replace, or we were staying in for it to hit a 1.618, it didn't do that. Instead, it returned and fell. By buying the 618 with a stop at the last low, our losses are small, and there's no need to incur big losses. There are downtrend crowns inside of crowns. Let's look at this. See this overall downtrend? Look at how we have a small little crown there, left tip, center tip, right tip. Pause your machine and really look at these. Then you have another crown, left tip, center tip, right tip. See how it came back up to resistance? Look at this big crown, left tip, center tip. Look at how it came all the way back up to resistance. Once it came up to resistance, formed a high, it fell, made a right tip. This is where your latest level of resistance becomes future levels of support. Lesson 2, rallies. Not all crowns are geometric. Look at how this one looks very different. Look at this. Left tip, center tip, left tip, center tip. Look at how it came up here, formed a right tip, fell, came up, tested it again, fell some more, formed a deep left tip, then took off. Very different crown. Now the best way to understand what you've learned is to write down what you think you know, then go back after you have been taught and look at what you thought you knew versus what you now know. Remember we did that exercise? Put the machine on pause and flip your book back and find the pages and look at what you wrote down about the end of a trend, a reversal, or a king's crown. This was chart number 1, Japanese yen 4-hour chart. Did you see all this? Look at how you have a downtrend crown. Market rallied, broke a trend line. You have an uptrend crown. Market came down, broke a trend line. Believe it or not, you have a crown right here. Left tip, center tip, right tip, rally. Market went up, crowned again. See all those crowns? This is the Dow 2-hour. Did you see this? See how the Dow was in a downtrend, making lower lows and lower highs? It's when the market breaks a trend line, comes up to the last level of resistance. If you're a stock trader, or if you do trade the Dow, the NASDAQ, the S&P, ways to find out whether or not you should get in, or if you like to hear about hot tips. Listen, if you hear of a hot tip and their stock is just falling, why would you want to get in? Why don't you wait until it crowns and creates a downtrend crown, then buy the stock? A person tells you, hey, you need to buy the stock. It's at $30. It's going to go to 200, but it's falling. All of a sudden, it crowns all the way down at $10. You wait till it crowns at $10. Now you buy the stock. You can contact your friend and say, hey, look, I bought the stock at $10. And then if it goes to 200, look at how much better off you are than your friend who bought it at 30. Here's the British pound 1 hour. Did you see these crowns? Pause your machine and digest these. See how they work out. Here's the Euro 4 hour. Did you see these crowns? Look at how the market broke the trend line. Left tip, center tip, right tip. Rallied, making higher highs and higher lows until it breaks the trend line. Left tip, center tip, right tip. Center tips of crowns will become the lowest low or the highest high of the new up or down trend. Did you see all these crowns? Look at this crown here. Look at this crown here. Uptrend crown, uptrend crown. Look at this downtrend crown. Look at this downtrend crown. Rules to trading a crown. Here they all are. Find and draw your trend lines. These are all the rules. Find your levels of support and resistance. Pull out your trader's checklist. Become familiar with it. Find your last level of support and resistance. If you can't afford it, stay out. Let's all agree, you've got to have an edge. You need to educate yourself so you know where to get in and why, and you know where to get out and why. Let's all agree, understanding that the market reverses and forms crowns and how to trade them, is that profitable? Absolutely. Realize that money can be made trading the crown reversal. Now, did this lesson teach you that the market can only move up, down, or sideways? Did this lesson teach you to read a trending trading chart and be introduced to the technical side of dealing with the reversal? Did this lesson teach you how to identify a reversal and how an uptrend and downtrend crown are formed? Did this lesson teach you how to find a trading opportunity in those reversals? Did this lesson teach you how to create a trading plan and financially protect yourself? If this lesson didn't achieve these things, go back and replay it until you understand it. Because of this reality, 90% fail because they just don't take the time to educate themselves on what they're doing. This is a zero-sum game to where losers pay winners. If you can become one of the 10%, the payoff is huge. See, successful traders will do what unsuccessful traders won't do. Successful traders go figure this stuff out. Why? Because there's a lot of money to be made. There's two ways to pay for your education in this business. You can go work hard, accumulate a little money, put it into the market based on a broker's recommendation or a hot tip. But if you're out there just trying to become lucky, and if you make money based on that luck, believe me, it'll only be a matter of time that you'll become unlucky and you'll lose that money. The saddest part about what happens is if you get burnt on a hot tip and you don't know what you're doing, then you don't know how to earn it back. And that's where education comes in. The second way to pay for your education is go find a mentor. Go find somebody who knows how the market works. Look at how valuable this lesson is that I just taught you. Working with a mentor and getting an education on how the market works is like buying a map to a gold mine. There's lots of money to be made in the market. You can see there's lots of money to be lost in the market as well. But if you can buy a map to the gold mine and then learn how to extract that gold out of that mine, then it becomes well worth it. And if you end up losing money along the way, the greatest part about your education is once you've been educated on how the market works and you lose money, you know how to go about jumping back in there and earning it back. Let's face the facts. All of us as traders, we have to pick a number, and we want comfort in the number that we pick. We want the trade to pay off. Every trader wants the market to move in their direction from entry. We don't want to jump in the market and watch the market dip or fall and go against us. We want it to move in our direction from the beginning. Look at how just learning the reversal, the King's Crown, pays off and how it increases your percentages for a payoff. There are 16 very valuable lessons on trading the Forex. They also focus in on technical analysis. I've shown you Dow charts, Microsoft charts. These, it doesn't matter. If you have a financial portfolio, pull those charts up. Go find crowns. Go find out where you should have got out or where you should have got in versus where you got in. Every one of these lessons come with trading exercises just like we have here. Every trader needs to have a mantra. Think about it. Successful people will do what unsuccessful people won't do. Successful people will educate themselves before they enter the market. They'll find out how this market works. The most amazing thing is that you can figure out how this market works. Look at what I've showed you so far. They'll learn how to place a trade. They'll learn how to find a trade. They'll trade with equity management. If the risk is too great, they'll stay out. They won't trade without protective stops. That's how you last in this business. They don't chase the market. They're usually patient. And if the market doesn't meet their criteria, they usually don't trade. They wait until something else comes up. If the chart is not clear, or if it doesn't visually make sense, don't worry about it. When in doubt, stay out. Because of this 21-day 3% rule, the human mind forgets 80% of what it has been taught the first 3 days. Chances are, if you shut this machine off and you don't go back and really study the crown, you're going to lose the information, 80% of it in 3 days, and after a total of 21 days, you'll only retain 3%. Market Traders and Forex Tips does not want you to open up your margin account and start trading with only 3% recall. Play these lessons over and over again. The potential reward is worth the effort. Now, on behalf of everyone here at Market Traders and ForexTips.com, and on behalf of your family, and on behalf of your financial portfolio, all of us thank you for investing in yourself, taking the time to listen to this lesson, and taking the time to educate yourself on how the market works. Remember, once again, successful people will do what unsuccessful people won't do. Who are you?